Is it all right if we kick it off?
Yeah, recording
All right,
is
awesome.
going.
All right, awesome. Well, welcome everyone. Welcome to DeFi Club AMA with many of the team members from Yuma. And we usually like to keep this to around an hour. Sometimes it'll go a little bit over. For those who have not joined, we're waiting for the killer feature of Clubhouse to be launched, which we really hope that there's a calendar feature at some point. In the meantime, we now have a Telegram channel. So go to t.me/DeFi Clubhouse for the calendar of events coming up. And that's really it. We'll ask the team a bunch of questions for a couple, probably about 10, 15 minutes, and then we will bring people up to start asking other questions. So I'd like to start off with super brief intros, super brief. So I'm Rob Banke. I'm co-founder, CEO over at Halborn. We're a cybersecurity firm wholly focused on what I'm calling essentially the convergence of CeFi and DeFi. So we're working with lots of DeFi projects as well as centralized finance and now some Fortune 500s as well. That's it for me. When we go to Tom and Min real quick, the little host intros. Min.
Hi guys, I'm Min. I currently work at a CeFi company for my day job. I'm working with various DeFi companies, consulting for them at night. So super excited to be here and super excited to have you here, Hart. I've heard so much about you, so it's an honor.
Well, I'm happy to be here, guys. Tom, you want to do your intro before I start talking?
Yeah, for sure. So I'm Tom. I've been angel investing in crypto and DeFi for a while, and co-founded the DeFi Nation community with Clayton. Did some tinkering on UMA mid last year, and now building a crypto options and derivatives exchange called PowerTrade.
Awesome. So let's get a kick started here. Hart, typically with these AMAs, I like to go past, present, future. So your intro certainly doesn't need to be quick. So tell us a little bit about yourself. Where did it all begin?
I can keep it quick, Rob. Like, you guys can ask me lots of questions, but if you want the past, I studied computer science, ended up as a bond trader at Goldman Sachs, true CeFi, old school CeFi for a while. Left that to do a startup, and then got hardcore in the DeFi thing 2017, call it. And so UMA stands for Universal Market Access. Whole thought process here is that financial services today are hilariously localized. I'm in Canada and I can't get access to the same financial services that somebody can in the US. And that makes no sense when we have digital money and when we have the internet and a global system. And so sort of my viewer thesis getting into this is that blockchain and crypto digital money is going to enable us to build systems that allow for like the global transfer of risk. And my background in derivatives or derivative-like things also means this sort of made some sense to me. And so we're all about looking at how we can build protocols that allow risk to be transferred globally to anyone that has an internet connection and some digital money. And our starting point here is things that we're calling synthetic tokens. So these are crypto tokens, ERC20 tokens, that are collateralized with some other ERC20 and can be used to track anything. Can be used to make a representation, a type of risk of really anything that has a price. I'll stop there.
Got it. We're here today to definitely talk about this decentralized finance project. Before we dive into that, I'm always curious of like histories and how one thing leads to another. So there's a bit of a gap there. So you're working with Goldman Sachs for for a while, obviously in the centralized finance world. But then did you start a company shortly after that?
Yeah, I started a company called OpenFolio, which was a personal finance company. It was sort of like a wealth tracker, like a mint.com, but for your investments. And our idea here was actually we wanted to crowdsource investment advice. And we actually found out by people shared their investment portfolios for us, not how many dollars they had, but like their percentage ownership and their trading activity. And we were able to see what good investors looked like and what bad investors looked like. So I did that for about 4 years, and that company was acquired by an asset manager in New York. Yeah.
Awesome.
So it was a pretty fun experience. And we learned a lot of random things, like most people really are actually bad investors. We learned that on average, it does pay to not trade too much and to be a long-term investor. But we also learned that a lot of people don't listen to that advice and like to trade around and have fun. So it was pretty fascinating.
So the thing with entrepreneurs such as yourself is that they're definitely roller coaster experiences, right? Like you have the highs and the lows. Like it sounds like you were fortunate enough to have an exit. It was obviously roller coaster. Then you go on, and in 2018, which wasn't long ago, but in 2018 this idea comes. So can you tell about like sort of the very beginning, like what was 2018 like throughout the bear market that some of us in this room were definitely sitting around in as well?
Well, so, the bull and bear market cycle has its pros and cons, right? 2017 I've been around crypto since the relatively early days. I've been fortunate enough to get introduced. Actually, when I was at Goldman, Fred Ursum is like my buddy and introduced me to crypto before he was part of Coinbase. So he's my origin story.
There you go.
So I know him pre-Coinbase relatively well, and I mean, frankly, I should not have started OpenFolio. I should have just gone into crypto full time then, like he did. But bull and bears, like the bull cycle of 2017, does draw people in, like this bull cycle is. It makes it hard to not think that there's something going on here. And I don't know, Rob, like 2018 wasn't a bad year for me at all, because we were building our team and we were just kind of like, we didn't really care about the price. We were just like, damn, this blockchain thing is cool. And we really felt like we really felt like there was a DeFi thing. This is kind of before DeFi was a term. DeFi didn't exist until I think sometime in 2019. We were just like a global financial system. Let's build derivatives on the blockchain. Noah Jessup, who's actually in here, is an advisor and like a thought partner in thinking through a lot of this. And we wrote it down in a white paper, or I wrote it down in a white paper actually in the Philippines, Clayton, where Clayton is. I went there and wrote this white paper in February of 2018.
And then leading up to that, okay. So I mean, that's fantastic. So let's go to the present then. I mean, you obviously described what's up with currently at this moment with Yuma. I mean, what has this? So we're definitely not here to talk about price whatsoever. All right, clearly. What has this last year sort of been like? For you while building out, obviously pushing towards decentralization of the protocol, obviously spinning up new features, building the community, seeing the rise in popularity of your protocol. I mean, what has that been like on your on your psyche and as sort of company morale, I'd say?
Honestly, I think we're just having fun. Yeah, I feel we all, I think, feel pretty fortunate that we get to work on interesting problems. And the price stuff is crazy, right? All these valuations and all this stuff is all quite something. But the problems we get to work on are absolutely fascinating and kind of just keep getting better. And so frankly, it's just been fun to keep crushing new and interesting problems and putting out, just seeing how this DeFi thing is evolving.
So speaking about DeFi evolving, Tom, let's dive into that.
Yes. Yeah. So UMA has been very interesting to me. Just interested in synthetics in general, and being super involved with Maker. So I think one of with UMA you can kind of create any synthetic price peg with any collateral. But what was really interesting to me was the DVM mechanism, which is basically the replacement of the Oracle strategy. And so can you explain a bit to folks, like, what is the DVM, and maybe we can dig into a bit how that works?
Yeah, totally. So DVM stands for Data Verification Mechanism, which maybe is like a shitty or overly technical name, but the concept isn't that hard, or the concept is kind of cool. And we've actually almost generalized it to what we're calling, Tom, the optimistic oracle. And we're actually going to publish something about this soon. The idea here is that instead of pushing prices to the blockchain, like Maker does or Chainlink does, instead of pushing prices to the blockchain and saying these prices are truth, and we will use them for liquidations, we instead don't push prices to the blockchain at all. We instead let people decide whether somebody is under collateralized off-chain. All the monitoring happens off-chain. Do liquidations whenever they determine a liquidation should happen. However, we time lock those liquidations for a period of time, for a challenge period. And it's if someone disputes that liquidation, anyone can dispute an invalid liquidation, or can declare that liquidation was invalid. And those disputes go to the DVM to be resolved. So what we've really done is we've flipped the Oracle problem around, and we've made it a dispute resolution mechanism. So we're saying, hey, only call the Oracle if you think something's gone wrong. And then we build an economic game around this, and we make it expensive. We make it costly for somebody to abuse this system. And it turns out that if you do this and do it correctly, you really don't need to call the Oracle at all. The simple threat of the Oracle means everybody behaves correctly. How's that for a high-level explanation? You want me to dig deeper?
I think that's great. And what's the new name for it? Optimistic Oracle?
We're kind of generalizing the concept to the optimistic oracle. So the optimistic oracle is basically this contract that you can ask it for a price, and any contract can ask it for a price and can specify a challenge period, and then anyone can report that price, and provided nobody challenges that reported price during the challenge period, no one disputes it, it will get finalized at the end of that period. But if anyone disputes it, then it goes to the DVM for dispute resolution. So the analogy that we often use here, it's like, Tom, you and I could write a legal contract, like a private legal contract, that says, hey, it could make a bet on something, whatever the terms are. And that legal contract is enforced by a court system that, like, if you don't follow the terms of the contract or I don't follow the terms of the contract, we can sue each other. But our hope, or the whole design of the contract, is that we don't want to sue each other. It's costly to do so. We shouldn't have to do it. That's effectively what we're doing here with this, like, optimistic oracle. we're saying, hey, let's do everything correctly, but we can sue each other and take it to the DVM. We can dispute this and take it to this broader mechanism if anything goes wrong.
I love the new name. I think it's very descriptive. And yeah, the approach is very interesting because like projects that rely on an oracle writing price to the chain all the time, they're susceptible to front running attacks, and also the cost of gas of just including that data in every block is very, very high. So I really do like the incentives of kind of getting people to come to agreements and follow their agreement on their own without needing the oracle to decide for them. But so you have these two counterparties. They're in a transaction with each other. They've got an agreement, and they're kind of incentivized to follow that agreement. But what if they don't follow that agreement, and it does go to the DVM for dispute resolution? Is that you? Is it like Hart says that this is what the outcome is, or how does that dispute resolution work?
So no, it's not me. It's the UMA token holders. It function as this distributed voting system where the voters are incentivized to participate because they're paid a reward if they vote and they vote correctly. And correctly here is determined as voting with the majority. So it's basically an economic game. It's a game theory game where we're like, hey, all of these token holders, you're going to get rewarded if you choose the majority outcome. And the game theory shows that people will pick the correct outcome. The Schelling point is going to be the truth here. Yeah. So effectively, it's a distributed voting system across our UMA token holders who are paid or rewarded with an inflationary reward for voting correctly.
And so, what do you mean by Schelling point? How do you know that people will pick the correct outcome?
Well, what should the outcome be? Like, what if you don't know how everybody else is going to vote? That's the other key feature here, is that there's this commit reveal thing. You can't actually see what somebody voted until they reveal it, until everybody else has voted. If you can't see how everybody else has voted, you want to get your reward, and you're going to lose out on a reward if you don't vote correctly. The only answer you can come to is to vote the truth, to vote what you truly believe the outcome is, which is pretty damn cool. Vitalik wrote a paper on this on Schelling coin back in the day, and there's been some other work done by a project called Truth Coin way back in the day. But it's a very interesting game theory concept that works in practice.
So the idea here is that if there is a truth, then that's like the number that everyone will converge on independently without knowing what everyone else is doing.
Yeah, exactly.
Cool. So so it sounds like 51% of UMA token holders basically will decide the outcome of this vote. So what if somebody owns 51% of the tokens, or 51% of the token holders are colluding with each other? Could they then attack the synth holders?
So if somebody owns 51% of the tokens, they control the system. That is true. They basically function as like this single arbiter. But nobody owns 51% of the tokens, and that's part of our token distribution and how we go about this. We want to make sure that there is enough honest participants or enough distribution there to keep things secure. In terms of collusion, there is also really interesting game theory at work there too, because you could imagine a group of token holders colluding to say, hey, let's all vote for the wrong answer here because maybe we can figure out a way to steal a bunch of money. But there's a cost to this, which is their UMA token value will drop if the system turns out to be insecure. So if the system turns out to be corruptible. So if you're a bunch of token holders, your incentive to collude doesn't exist, because if I do collude and I'll vote for the wrong outcome, maybe I make some money on that one manipulation, but I lose more money on my token value going down.
But what if my tokens are worth less than a synth that I'm trying to corrupt in some way?
Yeah, so we have this concept or this model, what we call our profit of corruption versus our cost of corruption. And this was a lot of our early thinking that we spent a lot of time around on how to guarantee that we don't get in that situation you're in. So basically what we're saying is, let's imagine a world where this system is securing $1 billion worth of value. $10 billion worth of value. What if there was some manipulation that could make an attacker a $5 billion value? It better cost that attacker more than $5 billion to pull this attack off. So we're saying the cost of corruption is how much it costs the attacker to succeed in this manipulation. The profit from corruption is how much money they would make. If there is a situation where an attacker could make more money than it would cost them to pull off the attack, that seems like a security vulnerability. And we designed our whole economic theory for our system, for the DVM, such that the cost of attacking is always greater than the profit you could make. I don't know how much detail or how deep you want me to go on this, but it's just a really interesting concept, I think, of, hey, we want the system to be secure by making sure that we can't steal more money by cheating than we can by being honest, is the thrust of it.
Yeah, maybe a high level of the mechanisms in place to ensure that happens.
Yeah, so in the initial designs of the system, it's still in effect now, we want to have every contract using the system report how much value it's securing. So basically, what would be the profit if I could cheat that specific contract? So Tom, you and I have some contract, or we have some synthetic agreement or whatever else, and if I could control the oracle, how much money could I steal out of that contract? And we call that number the profit from corruption for that contract. So we had every contract in the system be able to report this value, and then we can sum them all together to calculate a global, absolute worst case profit from corruption number. And then we know, hey, here's how much value could be stolen in an absolute worst case. Everything gets corrupted by the same person all at the same time. And Tom, by the way, that's a very unrealistic assumption. It would be impossible for someone to be on the right side of every trade and figure this out. But let's just take it as the absolute worst case assumption. We're then okay, well, let's make sure that it would cost them more than that amount of money to corrupt the UMA token holders. And that means that we need the market cap of the tokens to be twice that level in this rudimentary system. And how can we do that? Well, what we can do is we can observe these two numbers, our cost of corruption and our profit from corruption. And as long as our system looks secure, we don't have to charge anybody anything. We're good. But if the system looks insecure, we can charge a fee to the contracts that are being secured by the system and use that revenue to buy and burn tokens to enforce this inequality. That's the core idea. And again, I don't want to nerd out too deep on this, but it is interesting game theory for sure.
So basically, the more successful the UMA synth ecosystem is, then the more likely it is to essentially push up the price of UMA to make sure that it is in line with the security concerns for the whole protocol.
Yeah, exactly. And if I were to even like keep it a little bit more high level, the way that I like to think about it, the protocol should be free to use as long as the system is secure. The protocol should only charge fees if the security of the system is threatened. And I actually think this is a pretty cool kind of business model where if you or system that's not really plausible in traditional like non-protocol structures, where the protocol is not rent seeking at all. It only seeks rent. It only seeks to charge fees to the extent that it needs to secure the system.
Yeah, that's very interesting. So it's like it's a demand market for security. If security is just a commodity, then fine. But if security is in short supply, then it starts charging a fee for it.
Yep.
Yeah, it's very cool. This is like one of those projects that I look at and I'm like, this would not work without the token or the token mechanics. And the most users won't interact with the token, but the whole thing doesn't work without it. So I think that's really cool.
Yeah, and actually, like Tom, it's interesting just coming back from like when we launched or when we were building this in 2018, or the ideas behind it. Tokens were evil, if you remember back then. Like like if you had a token, you were just considered a shyster because it was following 2017. That whole hangover. And I'll be honest, like I really disagreed with that. I was like, okay, well, look, like tokens can be evil, and there were lots of evil versions of them in 2017, but a token can be a very powerful tool for building incentive structures. And designed correctly, like I think we've done, it becomes a core component of what the protocol does and is. And so, I think that's pretty cool. Governance tokens have emerged as something else that's like useful and interesting. But I still hope that governance tokens, continue to kind of demonstrate why they exist and like what they actually do. And I think it's like not all tokens are the same. Just to pile on your point.
Yeah, definitely. They're not all the same. You can't compare them like you do stocks.
What's the definition of token, right? It's a representation of anything. So
yes. Yeah, literally anything. Let's dig into the synths a bit. UMA has a couple of synths. You have like USD synths. You have what synths do you have right now? Actually, I'm not up to date on the latest.
Actually, I'm not up to date. There's like been a lot that have
maybe Clayton.
Yeah, Clayton, but like give us the latest rundown of the newest shit.
Of the synths that are live right now. We have Bitcoin dominance and altcoin dominance, which are referring to the same thing you see on CoinMarketCap or CoinGecko. We have a few products. There's one called Stable Spread, which is a basket of ETH stablecoins versus a basket of non-ETH stablecoins. We also have Mario Cash, which is synthetic Bitcoin Cash. We have UGAS, which is synthetic Ether gas, ETH gas futures. Maybe someone else can chime in. There's more on the list. We have yield dollars, which are basically synthetic dollars you can borrow against Bitcoin and Ether.
There's project we're working on something with Badger that called B Clause, where you can actually borrow like a dollar, basically a zero coupon bond against your Badger Vault tokens, which I think is pretty cool. And yeah, there's eight new token ideas that we are voting on from a governance perspective today, right now, actually. So Clay, it's been accelerating rapidly the last couple weeks.
So definitely want to also open it up to the audience for questions coming up. Let's continue down this rabbit hole of synths, but let's also we'll get to you in just a second. Ed.
I'd like to chime in for a second, if I might.
Sure.
Yeah, I'm just going back to the DVM for a second, and this idea of corruption in particular. This is a question kind of born out of the Northampton, Massachusetts, Hart, you'll know this, reference John Abrashkin style of so capitalist liberalism, say. We talk a lot about corruption in terms of singular big bad actors that can monopolize, say, 51% of the system. But what about the kind of implicit complacency with something like a UMIP, where there's a culture of voting yes on everything, and if you vote no on an approval of some sort of admin like that, you're basically forfeiting your inflation rewards, and your vote is essentially sort of tokenized at that point. What's the value of having that, voting no, giving up your rewards, and being an individual actor who's not going to sway the majority, but what's the value of having the democracy at something at that level for you guys?
I'm not sure, Jesse, that like the governance of call it admin functions should be in the same system. Like whether should we approve something or not, I think that can go live elsewhere. There's things like Snapshot that I think make a lot of sense that we're very curious about and think could be used for a lot of our governance decisions. When it comes though to the real function of what the Oracle's trying to secure, like what is the price of something at a given time, you're not just blindly voting yes or no. You have to pick a price, and you pick the wrong price, you lose. So there is this whole idea, kind of core to our assumption here, is that you can't just be passive and just vote what everybody else is voting. You actually got to like do a bit of your own work. You got to work for it and figure out if that price is accurate or not. Figure out what you should vote.
I think that makes a lot of sense. Why the delay in separating those two things?
Development takes time.
Fair enough. And the voter DApp
needs to be refreshed.
Okay. But in terms of the ideology and the spirit of it, separating out those simple admin yes/no questions and being able to dig into the more specific pricing and those types of disputes, that's where you see the future going.
Yeah, I think that makes sense to me.
Thanks.
You're welcome.
Cool. So before we open up to community questions, I want to continue the train of thought down the synths path, and then also have some questions about a new feature that's coming up in UMA. But first, so for the synths, something that was took a bit for me to wrap my head around was this idea of some synths kind of act like futures, right? You have some collateral and you're cash settling the value of that in the future. But some synths are actually act more like an index, and they're not actually representing like a delivery of a thing. They're just kind of settling on the concept of a number. So I think probably the two that kind of demonstrate those the best are probably the yield dollars, where you have ETH collateral, you create a USD synth, and you're basically it will settle for some USD value in the future. And then you have something like UGAS, which there's not like a gas asset that can be settled, but you're just kind of predicting the index price of gas. Do you want to talk a little bit more about that, Hart?
Yeah, Tom. I mean, so not to make your head hurt, right? But so in traditional finance, the kind of concepts you're referring to are physical settle versus cash settle. Like, do I get gold? Do I have a gold future, and at the end of it, I get like a brick of gold or a barrel of oil? Or do I have something else, and at the end of it, I get some cash, right? The thing about crypto here is they're actually the same thing in this system, or in our design where everything is an ERC20 asset. Let's pretend ETH is also an ERC20 asset when you wrap it to WETH, right? Everything is an ERC20 asset. And at the end, I get a bucket of ERC20 assets. And so you're right that kind of conceptually for like the yield dollar thing, my collateral is Ethereum or wrapped Ethereum. And at the end of it, I get $1 of wrapped Ethereum. For something like UGAS, or let's take something else. I'm tracking Bitcoin dominance, right? My collateral is DAI, and at the end of it, I get a pile of DAI based on this index value. It sort of makes your head hurt, but they're actually the same thing, where at the end of the day, I'm just getting a certain amount of ERC20s according to some payout function. Does that make sense?
Yeah. So the thing that was kind of the aha moment for me was kind of seeing that the index number can be represented against really any collateral, and it doesn't necessarily need to be if you're looking at a price feed, it doesn't necessarily need to be the collateral that's part of that price feed.
Yeah, exactly.
Yeah. So the important thing here that you mentioned is that these things settled, and so what is the mechanism that really keeps synths to keep their peg? What keeps them in line?
So cool. Let's do a little financial engineering. A futures contract. So traditional finance, any derivative in traditional finance, actually, any derivative has an expiry date where at the end of some period of time, you get something, and it's either physical settle or cash settle, like you were referring to, Tom. So again, let's take a gold future. I could have a gold future, and at expiry, I'm going to get a block of gold. The reason why they all have expiry dates is like, well, you know that at this point in the future, I'm going to get this thing. Before that point in the future, the price of the gold future and actual gold, like spot gold, could deviate quite a bit. And it could deviate for like legitimate reasons, like maybe it costs a lot to store and secure gold, so I'd actually prefer to not have to do it, in which case I'd pay a premium to have a gold future. Or maybe I expect gold to be more expensive in the future, or whatever it might be. But you do know that at the expiry date, these two things will be the same. The gold future and the spot price of gold will be equal. So arbitrageurs, when they think the price of a gold future and the spot price of gold, when they think they're too far apart, arbitrageurs can buy one and sell the other. And that keeps the synthetic price in line with its underlier. What we've started with is the same concept. So all of our synthetic tokens to date are expiring synthetic tokens that have an expiry date at which the synth is equal to some amount of its underlying collateral. And between the expiry date, the synth price can deviate from like what the spot price is, but we know that they will equate, that they will be convertible at that expiry date. And so the synth price is bounded to reality. Next up is like the idea of, okay, well, how do I make this thing perpetual? So,
yeah, there's a problem here, since the synths are put into balancer pools and Uniswap pools. When they expire, all that liquidity is, it kind of disappears, and then you have to coordinate everyone to roll liquidity into the next expiry. So it causes, particularly in DeFi, where it's not really coordinated like it is on a centralized exchange, it can cause some problems, right?
Yeah, it's kind of like the reason why not many retail users trade futures in traditional finance. Not that many people are trading like S&P 500 futures or whatever else. They just don't want to deal with what's called the roll, when I roll my expiring future to the next one, or my soon to expire future to the next one. And so, yeah, Tom, like there's a UX thing with these expiry dates that people don't like. Some things, the expiry dates do make sense. Like options naturally have an expiry date. I'm betting on a call or put options at a given date. But for many things, people don't like this experience. So what BitMEX actually did, BitMEX, in my opinion, really was the first to invent or popularize this idea of a perpetual swap. And people don't really think about it, but in that much detail, perpetual swap is a very weird instrument in terms of what's happening under the surface, where in a perpetual swap, you never, like the Bitcoin perp, you never actually get a Bitcoin. All you do is get a stream of funding payments that are going to perpetually push the price of the perp contract towards the Bitcoin index price. So it's actually this really bizarre and very interesting financial contract where it's self-referential, right? The value of a perp swap is in this stream of cash flows, the stream of funding payments that are going to push the price of the perp back towards whatever the price of a Bitcoin is. Does that make sense?
Yeah. So on a centralized exchange, you have that funding rate, and the longs pay the shorts, whether it's negative or positive, every 8 hours or whatever the funding rate cycle is, and then that tends to keep it in line.
Yeah.
So in the UMA world, how does that work? Because with since the way they are right now, the DVM really only comes in if there's a liquidation dispute or during settlement, right?
That's right.
So how does that work in the UMA world?
Well, let's look at Maker for a second, because Maker really well. So Maker is a synthetic token, and let's think of single collateral Maker just to make it easier. Maker is a synthetic token where I take Ethereum and I mint a synthetic token that is supposed to be worth $1 of Ethereum, or it's supposed to be worth $1 backed by Ethereum. What Maker does is they use interest rates. Interest rates and funding payments are basically the same thing. They use interest rates and they adjust the interest rate, and the creator of the token, the CDP creator, pays money to the token holder, the DAI holder, to make sure that the price of DAI stays at $1. And this works really well in a positive interest rate environment, where as long as interest rates are positive, we can take money from the CDP creator, the person that minted the token. We can take money out of their margin account, out of their CDP account, and use it to pay the token holder, to pay the DAI holder, to make sure this token stays on peg. The problem is what happens with negative interest rates? How do you make a payment go the other way? And if we're trying to build this infrastructure in a generalized way, which is what we're trying to do, so we can really make a synthetic token to track anything, there's going to be lots and lots of circumstances where there are negative interest rates or negative funding payments, where the token price would trade at a premium, and we actually need the token holder to pay the token sponsor. So we got to figure out a way to charge the token holder something and pay it to the token sponsor if the synthetic token is trading at too high a price. That's our challenge in building a perpetual synthetic token. So far, does that kind of make sense?
Yep.
So then how do we do that, right? Well, what we can't do is, because a token holder is offline and just they're not, we don't have their money, they have a token. How do we can't just charge them something. The two methods that we really think you can do here is that you could literally take the token holder and say, okay, you had one token, now you have less. Now you have 0.99 tokens. And what you've done is you decrease the amount of tokens the token holder has, and you've also at the same time decreased the debt that the token sponsor has. So you've made a payment from the token holder to the token sponsor, And this is like a rebase. This is like an ample or YAM style rebase to make a payment from token holder to token sponsor. The other way you do this is you change the value of a token. You change the index value that you're tracking. So you don't change the number of tokens a token holder has. You instead say that that token is worth less. So instead of that token being worth an ounce of gold, it's now worth 0.99 ounces of gold. And the token sponsor that previously was like had borrowed or had a loan for an ounce of gold now has a loan for 0.99 ounces of gold. So it made a payment from the token holder to token sponsor. These two methods are fungible. These are two, like they're exactly the same economics. And they're a powerful way for us to be able to have negative and positive funding rates, or basically negative and positive interest rates, between the token sponsor, the creator of the token, the short, and the token holder. And we have gone ahead and implemented the version where we change the index value. We're not changing token balances. We're not rebasing to maintain ERC20 compatibility, but we've gone ahead and implemented the version, and we actually just deployed it to mainnet. It's been audited. We deployed it to mainnet yesterday of this perpetual synthetic token.
Interesting. So the value of a synth will behave a bit more like a CDI, where it's not really 1-to-1 anymore, and you kind of have to. You can't know the value of it just by knowing how many you have. The question I have is, all right, so how often does that happen? One, and then two, it sounds like you actually need some sort of oracle in order to make that adjustment.
So how often does what happen, Tom? Just to be clear.
The funding rates payment. So if you're adjusting the index price based on the funding rate, is that settling on a cycle like 8 hours, like traditional perps?
Yeah. No, good. So the way this is implemented is the funding rate payment is happening continuously. So there's a given funding rate, and it's just continuously like accreting, much in the same way, like the way you mentioned CDI is spot on. So much in the same way that CDI is like always accreting in value. Here the funding rate is being applied continuously over time. What has to happen though is we have to change the funding rate periodically to make it go up or down. The funding rate is always applying, but then we need to make changes about whether the rate should be higher or lower. And here's where we're using the optimistic oracle, where anyone can propose a new funding rate to this perp contract. Anyone can propose a new funding rate whenever they want. And that funding rate will be adopted as the new funding rate after a 2-hour challenge period, provided nobody disputes that funding rate, the proposed funding rate during that 2-hour period. So to us, this is like another like actually truly decentralized way for us to build these perps with a continuously adjustable funding rate to keep them in line.
Interesting. So the funding rate is actually just another index for the DVM to kind of be a custodian of, in a sense.
Yeah, I mean, won't use the word custodian, but I know what you mean. It's like for it to govern, for it to secure. Secure is probably the best word.
Yeah, interesting. And so the funding rate is actually unlike traditional perps where the funding rate is pretty dynamic based on supply and demand. The funding rate in this case is relatively static, and if anyone wants to change it based on kind of the market needs, they'll have to pay some gas in order to make that proposal, and it will have to kind of fit within the market's requirements.
Yeah, this is where we got to run the experiment to see. I'm actually quite excited to do this. So I don't know how static these funding rates are going to be. I think it depends. Well, it depends on the perp and what it's doing, and depends on market conditions and the environment. I think there's going to be some products where the funding rates get adjusted pretty rarely. I think there's other products where they are adjusted hourly too. It's going to be interesting to see, and I'm not really sure we can predict it before we try it.
That's interesting. I assume it'll be adjusted based on the volatility of the premium. If an asset is not trading at a premium, then nobody really needs to change the funding rate. But
yeah, there's a reward that's paid. There's a reward that accretes that's paid to the funding rate proposer to just basically make sure these things are updated with some frequency. And again, there's going to be a lot of experimentation for us about how big that reward should be, and how like should that reward actually scale, like a more sophisticated version, is that reward scales with maybe volatility or some other metric. There's like a lot more kind of like research experimentation we can do there.
But also assume that there's good arbitrage opportunities where if you see the market is like pretty offsides, you can take a position and then go make a proposal to change the funding rate to your favor, right? Yeah,
that's the thought. I think, again, going to be really cool to see how that works in practice, but that's the goal.
Hey guys, sorry to interrupt. Just noticed we had now 4 people in line with questions. Just want to make sure we had time to tap them as well. Sorry.
Yeah. This is fascinating. The perps thing is something I've been wanting to learn about for a while. So glad we got a chance to share that with everyone. But my curiosity is satisfied, and I yield the floor to the audience.
I know Kristen's been waiting. Let's do that. Let's start
Hi.
there.
Hi, it's Kristen. I hope you guys are doing well. Great work. I've been in derivatives for 20 plus years. I've been involved with ISDA, and I run an exchange now, a capital markets infrastructure company. But I would really be interested in talking to you about a lot of the issues that I wish you could see my notebook right now. I have about 75 questions for you, so I can't really ask them all, but I would love if you reached out to me, and I could talk through a lot of what you're talking about. There's bankruptcy issues, there's legal issues, there's structure issues, there's Oracle issues. I'd love to talk to you. I think probably it's not the right time, but please reach out to me. I'd love to talk to you.
100%.
I think we'd also like to know the answers to some of his questions as well. I don't know if maybe the bankruptcy one sounded interesting. Maybe there's one you can ask.
Yeah, so collateral is really a very jurisdiction-based issue. So how does that work? What are your thoughts on the bankruptcy issues?
I think maybe, Kristen, I'll give you like a high level answer, and then maybe something a little bit just about like bankruptcy and that we were thinking about it. There are tons of issues, right? Like this is like, just to be clear, we haven't figured out the world, right? There's lots of stuff to learn and know. But that's kind of the point, right? So it's like start doing this stuff and figure things out as we go along. With regards to bankruptcy and collateral, I'll share like one interesting thought here. So I think what you're kind of referring to is like, in traditional finance or traditional derivatives, you have margin on hand, and if a counterparty ceases to maintain a margin requirement or margin level, they get a margin call. And if they miss that, you sue them. You keep their margin, and then you go sue them in court for everything you're owed. And there's this like recourse mechanism that you can go and sue somebody if something goes wrong. The
Typically what would happen, for example, is that you'd have like, I mean, I don't know every scenario, but you'd have a really long contractual, argument, and there would be like a tri-party situation potentially, and there'd be arguments about whether the trigger was at X or at Y, and
Yep.
it's a very, it's definitely not an immediate settlement type of situation, because there's lots of there's 17,000 reasons somebody would call margin and be able to liquidate it, especially during 2008. Yep,
exactly. So let's take this as is that a feature or a bug, right? Let's say that's a bug, not a feature. And say instead that you're okay, we are going to have to figure out the value of this thing. We're going to have to settle or this thing within a couple days, with near immediately, and then we use this DVM thing to resolve this thing. I think that can be a feature, not a bug. And the other thing that's really interesting here, part of the reason why you have that long drawn out contractual process is you can't move money around very quickly in traditional finance. It takes a day or at least 8 hours. It takes hours to move money back and forth. But in crypto, we can move money quickly. With low gas fees, we can move money really quickly. But where we're going is we're going to a world where you can move money instantaneously. And if you want to think about how stuff changes, what if you can move money instantaneously? What if we can margin things in real time? What if we have continuous real-time margining? In that world, there really is no reason why you ever need to make a margin call. There should just be an expectation. People always have their margin there. And you can actually get extremely capital efficient where people are always they're just moving money instantaneously to keep things correctly collateralized. And I think that's the world we're going in. And this is sort of a way of implementing a risk transfer system or a risk transfer protocol that gets closer and closer to continuous real-time margining.
100%. I mean, I have clients call us all the time. They're like, it's 5 o'clock. Can you transfer, right now I want $500,000. And I'm like, oh, okay, I can't because, the wire's closed. They're like USDC. I'm like, okay, if that's good for you. That's good for us. But in the dispute situations that I've dealt with throughout my career, that's where I am more concerned. I mean, you guys are doing a great job. I'm just concerned that that the industry is not thinking through all the different ways in which there are reasonable disputes, and I'm sure you're aware of the determinations committee of ISDA. So when I took CDS, I before CDS, credit default swaps were credit default swaps. I was creating credit default swaps out of my head. And then it became commoditized. And then it went to ISDA. And then they turned it into an exchange product. And then we had to figure out an Oracle, a determinations committee. And there were lots of debates as to what that Oracle could do based on a whole bunch of criteria. Have you looked at that as a I don't know, something to reference at all? Or you're doing a great job. I don't mean to sound in any way critical. I'm just wondering if you looked at what people have done in the past.
Totally. I think there's a lot of, I think I probably agree with you more than you may realize, right? So if you think of DeFi right now, just to sort of summarize this or wrap this up, DeFi right now, there is no room for dispute. You take the on-chain price that's been reported by Maker or Chainlink, and that's it. You've got deterministic, it's final, it's immediate finality. I actually think that's a mistake, and we're trying to introduce in our whole process and thinking a layer of dispute, which is you escalate this to our token holders for them to opine on. And there's many thoughts that are drawn from how that works in a CDS determination.
Right. So, and there was a whole committee, who has conflicts, like how do they participate? Do they get out of it? You know, how do you figure out who's in, and, you know, do they have any economic interest in it? I mean, that whole process of creating the determinations committee was incredible. It was every single, you know, participant was weighing in on that process. So it might be an interesting for you guys to look at what they thought about. Mark New is the guy at ISDA that created it. I'm happy to introduce you. I wasn't part of, I mean, I was part of ISDA at the time, but that might be interesting for you.
Yeah, I mean, for us, like, this is where it gets a bit more radical. Our determinations committee is a bunch of anonymous addresses in crypto. And like, that's what we're going to go with. It's kind of wild, right?
Yeah, but really, is that going to pass regulatory muster? Like, you just don't know who's colluding with whom and who has whatever economic interest with whom, right? I mean, you want it to be fair and right and just, and you may not want it to be centralized, but you have to make sure that it doesn't have inherent regulatory issues embedded within it. You want it to be something that can pass.
I mean, that's a whole different question, right? So.
Yeah.
So, could I jump in for a second? Sure.
Go for it.
Yeah, I think it's a really good question. A lot of the price feed identifiers that we have right now, we try to keep it that it's really straightforward to calculate what the result's going to be. So I think this kind of problem is something that would come out maybe some years down the line, where we're trying to advance into more complicated questions of the true value of a thing. Where right now it's like, here's the identifier. If something went wildly wrong with this particular data feed, use your rational human judgment to correct that, because that does happen from time to time. But for the most part, you can just look at the data feed and say, yep, here's what it is. And everybody can reach an agreement on it. So in that kind of scenario, it works out okay, because you can just all gather around what the actual price is. I think the first dispute area would be if something catastrophic happened to a whole bunch of data feeds at once. It would be really interesting to advance at some point in the future into more complicated questions of a true value of a thing. But that'd be really hard for a bunch of random Ethereum addresses to determine, unless they had some guidebook to do it.
I would also say that design goals of most of DeFi right now is to, one, make it so that it's, you know, game theoretically unnecessary to have such dispute councils, and then also, second, most DeFi projects today are not really that concerned with being regulatory compliant, and for good reason. Like you know, there's a lot of innovation here that you know, regulation was designed to prevent certain issues that don't actually exist in the smart contract space. Because you have trustless transactions, you don't really have to worry about counterparty risk, and a whole host of issues there. You have real-time transparent auditability of every asset and every position and every transaction in the ecosystem. And so a lot of these issues that exist in the traditional financial system that regulations were created to solve are just completely unnecessary in the DeFi space. And so right now, I'd say, you know, most projects are not really solving for regulation or even attempting to be regulatory compliant. But I do expect that in the future, a lot of the tools.
I would just interject. Sorry. Sure. As a person that's very involved, I started DARLA, the Digital Asset Regulatory Legal Alliance, and I'm very involved in regulation, but I'm also an entrepreneur and I want to succeed. I would say that I've launched, I don't know how many different hedge funds and different entities. I am very cognizant of regulation and I want to make sure that I don't violate. There are definitely principles there that regulators are looking at, and we want to make sure that we're understanding what those principles are. And it's not asking for forgiveness, it's trying to make sure that we have that dialogue. I'm trying to have that dialogue. I want DeFi to succeed. I want all this to succeed. I want my company to succeed, but I'm just very conscious of making sure we understand what they're trying to protect.
Yeah, and I think like the individual will be more cognizant of that, but the protocol, the smart contract, there's not necessarily anyone to enforce rules against there. So yes, I agree. Like the individual is probably more aware than the code itself, if that makes sense. And I do expect that.
But out December 15th in 2019, his idea about the Commissioner Quintes said something about like just generally speaking. But I think the regulators, I mean, the SEC just came out with something, and I am again, I 100% support innovation. I just think saying something like, we don't really care about regulations, we're just trying to build and we'll figure it out later, is not. You have to be really careful. I'm sorry.
I'm just relaying the sentiment of like, most of the engineers in the space, and a good number of them are anonymous, and so they take that precaution for a reason. And so what I really do expect to see in the industry is kind of a bifurcation of like regulatory compliant DeFi and just like pure innovation DeFi. And so I totally expect that to happen. I'd like to see that happen. I think there's going to be like two parallel DeFi ecosystems that are building. But I think they both have their merits. So not to say
I think
that
also, just grounding it in the process of approving a price identifier with UMA. I think regulation makes a ton of sense when there's a lot of wiggle room in determining what the value of something is. And that's not really what we're looking at this point. Like for the most part, we're looking at, for example, if you're taking the price of a particular token, you could take the median of 3 prices from 3 exchanges that have a whole lot of volume. And it's kind of a scenario where, one, it's really easy to determine what the true price is. So all the voters should be able to coalesce on it, because that's a problem if they can't. And 2, it's really easy to tell if the voters are up to some shenanigans. And that would be really bad for the protocol. It'd be really bad for those voters and the value of the UMA tokens that they hold. So I think once you're getting into those more regulated areas, I am really curious to see where it goes, 10 years down the line, where you have less easy things to reason about that are getting integrated into a DeFi protocol in some way. But right now, that's not really where the process is at in like a practical sense.
Sean, I just want you to know that I like your cat. It's a cute.
It's one of the kittens. We adopted a stray cat who turned out to be pregnant, so now we have 4 cats.
Wow. I'm happy to talk to anyone that wants to talk about this through, just my background. I'm really happy to think through whatever you guys are working on, because I think it's really interesting.
Awesome. Let's Andrew. I know that a couple of others have been waiting around. So Andrew, what's up, man?
Yeah, this has been a really interesting discussion. I specifically really liked the discussion about sort of the perpetual and the discrete futures. I really didn't sort of understand all of the mechanisms at play with these perpetual futures, and so it's really interesting to get some insight there. My question was, I've seen a lot of sort of UMA initiatives based around incentives. So incentivizing developers to build on UMA, and then also people to interact with the protocols. And I guess what has been the effect of these programs, and how likely are you guys to extend them, go different directions with this? Basically, how have these incentive programs helped UMA?
Clayton, do you want to talk on that?
Sure. So developer mining has been out for several months now, and that is a program where developers receive a share of weekly UMA token distributions based on the value of the minted synths that they are responsible for. And so we've definitely seen an influx of developers who are interested in building on us kind of because of that, which has been very cool. And it's been an iterative process. So we were sort of worried about certain things in the beginning being gamed, and sort of sort of discovered that maybe we were worried about things when we didn't need to be, and so we're sort of pivoting there. And then, so that's on the developer side. And then we just recently announced this KPI options program, which is meant to basically mobilize our target airdrop, which will be announced shortly, early next week, hopefully. Basically mobilize them to help increase the TVL of UMA by giving them a conditional payout of UMA tokens depending on the TVL at the time of expiry of these airdropped tokens. So if you can sort of think about the conversation that just happened in this room, like we talked about how UMA can be used to kind of create value in an ERC20 token. And we're using that kind of, we're using it, we're dog fooding our own product basically, and using it to create this token that will pay out based on this metric, this TVL. And yeah, so I can't really speak to how it's benefited us yet because it hasn't been released yet. But what has been exciting is we've gotten quite a bit of interest from other protocols interested in participating and doing their own KPI option, which will incidentally lead to us increasing our own metric of TVL if they lock their foundation tokens and do options. Yep.
And Andrew, the only thing I'd add here to what Clinton's saying is that, experimenting with incentive structures is sort of what crypto is all about. Bitcoin is an incentive structure, Ethereum's an incentive structure, we're an incentive structure, and then all these other ways are just really fascinating incentive structures that we're having a lot of fun experimenting with. And I want to keep doing more of this and sharing our insights. We all as a project team want to share our insights back with the community and back with the ecosystem, because I think we are inventing some really cool ways of bootstrapping liquidity, bootstrapping developers, bootstrapping interest. I think there's just a lot of really fun stuff for us to build and play with.
Yeah, cool stuff. Love what you guys are creating. Love sort of the community that you're building around developers and people getting involved with these different. This is an extremely new type of asset. Like we've never really seen anything like this before, and so really breaking down that information barrier both for developers and users, I think is so cool, and I really like what you guys are doing. So keep up the good work.
Thanks, man.
Matt, what's up, Matt?
Hey guys, thanks for having me on. I love UMA. I love the project. I worked in the space for a little while, and I do have to say that there were some things that Kristen was saying that did sort of resonate with me as far as regulations are concerned. And anyways, I feel for you guys because it is quite a space to be working in, and a lot of challenges there in that regulatory area. But anyway, I wanted to ask you guys, this is more of like a general question. How do you guys, and you might have already talked about this, how do you guys see this space evolving when it comes to the Ethereum network versus all the other networks? Because right now what I'm seeing is Binance Smart Chain really gaining huge momentum. And if you go to DApp Radar, Binance Smart Chain is the top like 5 or 6 projects in the DApp space, and they're just going parabolic. And BNB is now number 4 in market share, and I'm kind of thinking like, wow, it may go to number 3 here pretty soon. So curious what your thoughts are on that competition and the no gas fees.
Binance is smart. Binance Smart Chain is smart. And I wouldn't underestimate them. I think, Matt, if you want like my personal view, the thing that is staying around is the ERC20 token standard. And so, by adopting the EVM, Binance Smart Chain is adopting the ERC20 token standard. Any layer 2, any other layer 1 chain almost needs to have a bridge for people to move ERC20s onto it by like default. And I think that there is, this is the ERC20 standard is an example of a standardization that is just one, even not a perfect one, like approvals and all that are kind of silly. But I think that's the thing that has staying power. And I think where those things live potentially can move around some. And, I personally am not a maximalist on anything. Maybe I'm a DeFi maximalist. But I think from our perspective, I feel like we're well positioned to just be a system that makes ERC20 tokens, and those can go and live anywhere we want them to live.
I see what you're saying. Yeah, that does make sense. I mean, we have seen a lot of bridge protocols come out of nowhere, and I imagine that's not going to stop. I just kind of think of, like, I've been thinking a lot about the market as a whole lately, and just wondering, is it possible that Binance Smart Chain could, BNB could flip Ethereum? I mean, I kind of wonder if it's possible, because when you're paying pennies for transactions compared to, $500, I mean, it's really, it's not looking too good to me. So anyway, I've just been thinking about that quite a bit.
So it's a lot easier to have lower fees and faster times when you're more centralized and less secure and you don't have as much usage. So, if Binance Smart Chain were to become decentralized, they would have the same problems that ETH Layer 1 is having as well.
Yeah, it's tough to get to that point when it's quite literally a clone. I mean, setting up Binance Smart Chain recently in my MetaMask last week, it was hilarious. Like, their instructions is literally go to MetaMask, set up a test net, a custom test net in MetaMask, and when it sets up in MetaMask, it's it still has the Ether logo in there, and it's just called BNB now.
Right, totally, and I get that, and I'm an ETH guy through and through. I mean, I love decentralization. I love DeFi. I mean, I love it all. But I'm just pointing out that most people don't really care about that centralization argument. And really, they're just looking for gains. And if you look at the total value locked, I mean, it's increasing exponentially in Binance. And so, I mean, I don't see that trend ending anytime soon. And I mean, the dApps are already overtaking Ethereum dApps in volume. So, just
yeah, but
EOS did the same thing. Tron did the same thing. Like, how much of it is real? I think for anybody who's seriously looking for security, the fees don't really matter that much as they are today. So I don't see. I mean, sure, yeah, Binance Smart Chain might get a bunch of volume. The token price might go up, but I don't see it unseating Ethereum as like the center of kind of decentralized finance. Not that it won't be successful in some regard, but it just like
it's certainly proving that it's quite successful. That is without a doubt. Will a flippening happening? Who the fuck knows? I sincerely doubt it. But who knows? I mean, it goes against all the OG principles for sure. Like, like that for sure is the case. It's very easy for every DeFi project, obviously. Like, it's very easy for Hart and his team to say, all right, great. Guess what, guys? Tomorrow we're floating the repo and we're a Tron project now. Or someone else is going to do that. And call it UMA Tron. So it's like, anyone can go off and do this, but I think the value will continue to be, kind of. I would just say it's sort of where the smart people are going right now. Like, it's where the builders are going. There's cloners and then there's builders.
I think there's one interesting point. I just want to make one point really quick here. I think, like, the point about like a lot of value moving over to other chains is interesting because as transaction volume and value moves over to the Binance chain, you're going to see Binance chain fees go up if their fees are at least proportional to the amount of usage, and you're going to see Ethereum fees go down. So there is an equilibrium point where, like, at the point where Binance flips Ethereum, like, you end up with Ethereum fees being low enough to where people can stomach them again. So I don't think it's like a sustainable thing for Binance to continue to increase its usage and Ethereum to continue to decrease its usage. But yet Ethereum to continue to have high fees, right? Because by definition, the high fees are because of the high usage.
Oh my God, Matt, did you just invent the fact that basically next year there's going to be Binance 2.0? Is Binance Smart Chain 2.0 going to be a thing?
I could imagine it.
Who knows?
You heard it here, Binance Smart Chain 2.0.
I think there's a way.
No idea.
I think the focus on yields is really interesting because I think that's also tied in with like the token price mania that happens around a lot of projects, and then ultimately the price mania around Bitcoin and Ethereum themselves, where to some extent you can weave this kind of money magic where you draw in a whole bunch of capital and then you use that to bootstrap a system that works better than the system that worked before. Like Bitcoin right now is a lot better than it was when it was initially invented. But ultimately, you do have to rely on those technical innovations. And the mainstream user that's going to be coming into this isn't really going to be thinking about like how secure is this consensus algorithm or how big are these yields? Because by the time they get here, the yields are not going to be there. Like the yields are kind of a mechanism to bring in the capital to make some other stuff happen. So if Binance starts going in that direction and getting more decentralized because they're able to draw in this capital, that would be an interesting development. So it's kind of the way that I look at it. I don't know if that's anywhere that this is going, but that's kind of my view of it.
And ultimately, we do have to all keep in mind that this is all, there are massive shades of gray within all of this. So for example, if someone hacks like YDI the other day, right? USDC as well as USDT Tether on ERC20s, they can censor and stop those wallets and they can stop those transactions. So there's all sorts of gray of proper like permissioned versus permissionless and decentralized versus decentralized. So, you know, that's why one of the, like, it makes a ton of sense why this is a term, but it also makes me like laugh out loud a lot is that CDFI is now like a term being thrown around, like centralized, decentralized finance.
Yeah.
It's a thing.
Yeah. And it's sort of a thing with Ethereum right now. You're paying these high gas fees because you're paying for security. And you'd like to not pay those fees, but you're going to have to explain how the system is as secure as it was before. So I think the layer 2 networks are a really interesting development right now because, you know, they're live, they're working. There's application specific layer 2 networks. There's generalized EVM compatible layer 2 networks that all have pretty good technical guarantees behind them. So I guess my honest thing with the Binance Smart Chain is I haven't looked at it closely enough because I'm a little bit suspicious of anything that seems too centralized. But I'm super pumped about the layer 2 networks, which are solving kind of a similar problem.
Yeah, I'm also quite excited about layer 2 because you get the scalability and the security guarantees of Ethereum. Wondering if Uma's got anything in the roadmap on the layer 2 front.
I think the layer 2 idea, just going back to kind of what I was saying to Matt's question, when you look at minting synthetic tokens or just like kind of actions in our ecosystem, minting tokens, redeeming them, or adding collateral are fairly rare actions. And yeah, they cost gas, but they just don't happen that often. It's trading tokens that's the problem. And so I think we get a lot get a lot for free by just producing ERC20 assets and then moving those to whatever layer 2 wins. And so, yeah, Tom, I think like we're just going to be a fast follower. Every layer 2 has an ability to bridge ERC20 assets. We want to encourage that. like create synths and bridge them to a layer 2. But in terms of our minting functionality moving to a layer 2, I don't think it's the right call to make a bet on one versus the other right now, given that it's not the most common action or not the biggest kind of gas guzzler of users of our synths.
That's a good point. You can trade on Uniswap's layer 2, and yeah, that makes a lot of sense.
Something else I'll add too, and this is kind of in the early stages, but like I know we've been talking with Matic about connecting to a certain prediction market around sports, and the way that this would work is that prediction market can operate entirely on a layer 2 and basically have an escalation game that would call the optimistic oracle in case of a dispute. And so only when it needed that dispute resolution would it need to come on to the layer 1 arbitration.
And I think that general concept that Clayton's talking about, that applies to like all of our internally built kind of contract templates as well. They could all be technically deployed on an L2 and basically bridge like 1 or 2 contract calls over to actually talk to this oracle, this optimistic oracle, or even the main DVM, and that all kind of works pretty nicely. So there's this nice big kind of black line in the middle of our system between the actual financial contracts that can really operate in these very small contexts like an L2, and then the oracle that provides information to them. And the connection between those two is actually pretty low bandwidth. So you could pretty easily put it on an L2 without too much effort.
Can I ask, how long do you guys think that it would take for a layer 2 to get wide adoption in the space? Like, I think is Uniswap version 3 going to incorporate that? I'm pretty sure it is, right?
Yeah, so Uniswap is working on optimistic rollups, as is Synthetics. Curve is on ZK rollups. Loopring Exchange has been live for a while. There are ZK rollups. So yeah, I think we have things that are kind of live in beta right now on mainnet, and we have things that are in testnet and things that'll be ready soon. So I expect the next few months to 6 months will be pretty exciting for the L2 space.
Nice. So you're, I don't know who you work for, but I'm assuming that it's pretty big considering that you just said all that. But I'm just kind of thinking from my point of view as an investor currently, I'm trying to think well, I'm looking at the Binance Smart Chain space, and which is actually exploding with 50% gains in one day, and I'm just trying to think where I should throw my money, quite honestly. And I'm thinking that right now I might stick to interoperable projects, but the layer 2 question is sort of stumping me because I don't know the timeline for that, implementation.
Got it. Yeah, I mean, at my last startup, I did a deep dive on all of this, so I got to know a lot of the layer 2 teams pretty well, and so I have my own thesis, but everybody has their own thesis. I tend to take a longer term view on things, and so the question I ask myself is is this going to be around in 5 years? Binance Smart Chain, the answer to me is no, just based on what I know of how I think the space will evolve. It from a short-term perspective, CZ is good at making things pump. So who knows what could happen there? But I wouldn't bet on it being around for the long term. But yeah, I think we should keep the questions more on Uma. Nice.
So Crypto Nice has been hanging out, being all quiet.
Yeah, hi. Hey guys, so very interested in DeFi. So more of a newbie question. When I think of CeFi services BlockFi, etc., that give you yield on your assets, and then I look at DeFi. Well, first of all, what is the advantage of using a DeFi application over a CeFi application? Will I get a better yield? Number one. And then number two, how do you advise someone who's not used a DeFi application before to go about it? What's the simplest way to get your feet wet without losing your Ethereum? Just any sort of direction would be helpful.
I think the simplest way is to participate in one of the kind of well-known lending markets like Compound or Aave, and you can lend stable coins or ETH. I think that's the easiest introduction.
Yeah, I mean, the part I've struggled with it with CeFi, it's obviously easy. You just send in your coins and you start getting yield. With DeFi, I've noticed you got to create some sort of pools. You have to pool two assets together in some ratios and all that. So, and I wonder if if I'm going to lose something and screw up when I'm trying to do that. I mean, what's the sort of the simplest, easiest way to get your feet wet? Is in which protocol? Is it Aave or is it something else? Is it
I agree
Compound?
I agree with Tom. Aave or Compound, like one of these lending markets where you're not doing this pool thing yet, or you're not doing this AMM pool, I think is a great first experience.
Okay. And why not a CeFi? I mean, why not just give it to BlockFi?
So if you want to do something that you can do with BlockFi, I would do I basically think do whatever service works for you. A lot of people in DeFi say, you got to be all decentralized. You got to not your keys, not your crypto, which is true. But honestly, that's more of a religion. I think what makes DeFi interesting is the things you can't do in CeFi. So in CeFi, you have big institutions that control what tokens you can buy and what markets you can lend against. They control the innovation. What DeFi does, I think, the part that makes it so cool and part why I think this year exploded, is it is truly permissionless innovation. Anyone can build anything and put it up there, which is both good and scary because people can also put scams up there or broken code up there or whatever else. But
Can I add to that?
With you, Hart.
Yeah.
Totally agree with you. It's really exciting. So exciting. There are risks, but it's exciting.
So to add to that, with CeFi versus DeFi, the reason I'm a fan of DeFi is because I'm in New York City, and with BlockFi, I'm not allowed to be on BlockFi just because New York City doesn't allow that. So with DeFi,
that's right, Eric. I'm right there with you.
It allows me to connect permissionless, no KYC, which will enter the market borderless, which will create better protocols, create better pools, and overall create better yields.
Okay, I just want to be clear. I don't know the regulatory framework for that, but I think you have to be careful because I think in order to work, I think the CEOs in Brooklyn, I think that they have Uniswap in order to be a DeFi developer. You get to, they want you to work in Brooklyn. You have to be careful. I don't know what I don't know, but
it's not really relevant though, because if they arrest the entire Uniswap team, it doesn't actually affect Uniswap.
Okay, but you know what? They still could, and so I don't know what that means.
Well, it's decentralized.
Very doubtful.
Yeah.
Saying that if everybody from Uniswap is arrested, I don't know what that means.
Okay, but from a use
for
Yeah,
Uniswap.
but legal entities don't exist in America. None of these decentralized protocols are sending.
Yeah, but is it illegal for an American citizen, say, to go and use these services? It's of course nobody's going to find out easily, but is it per se illegal?
The SEC is focused on protecting investors, so they're not so much concerned with investors putting money into certain things as they are people scamming for it's more like, are they going after the drug dealers or the people using the drugs, right? They're going after the drug dealers, so they're going after the projects basically.
What was the hack in Asia that happened that were 35% of it cleared through Uniswap? What was that? I don't remember. Do you remember?
Where what?
The hack in Asia where the hack went 35% of it went through Uniswap. Do you remember it?
Yeah, I that's happened with a few of them.
Maybe one
Harvest just got hacked, and then Alpha Finance just got hacked.
I don't know, but I just worry about that.
Well, so this goes back to what Crypto Nice is asking about. Hey, everyone, I'm brand new to this thing. Everyone's talking to me about, oh, don't get hacked. How do I do it the right way? So the way that you need to do this, Crypto Nice, is the way that you invest in anything. Take some time, take some deep breaths, acknowledge the fact that this is a massive evolving space. I speak on behalf of everyone on this panel that when you are knee deep in this space, working on your project day in and day out, there's no way to pay attention to everything that's going on just because of how large it is. So what Tom was saying is, every investor should have sort of a thesis, like, oh, I think this is a trend, and I think that that will make dollars go up in this particular manner. So take the time, do your research on what works for you in your jurisdiction for sure. Eric, I'm right there with Eric, where he's based in New York, I'm based in New York. Quick example, like I absolutely love the Flow blockchain, but I'm not allowed to buy Flow tokens because I'm not allowed to get a Kraken account. I'm not allowed to do a lot of things because I live in the jurisdiction of New York City.
Finance, yep.
There's plenty out there, right? So we don't have
buy
to go down
BNB,
that
and I knew it was going to blow up.
Well, right. So Crypto Nice, just take some time. I think Tom and Hart said it very, very well. Look at synthetics and look at Aave. Start there. Just start there. Don't go far beyond that to start.
Compound.
Spend like the next
No, I appreciate it. I got the gist. So the way I'm thinking about reducing risk is start small and also look at more mature projects. I don't have to jump into the latest and greatest. So if Aave and Compound seems like they've been around for at least a year plus, hopefully it's kind of stable and bug free and not, nobody knows it can't get hacked, but maybe you certainly don't want to try something new. So I assume these are the more mature projects. Is that right? Aave, Compound?
Yes, and the benefit there is like you can just deposit one asset and start earning a yield. And so, if you're looking to learn about DeFi, like sure, you can go do something in BlockFi and just if you want to earn yield, but what they're doing is actually they're putting it into Compound and Aave and other DeFi projects to pay that yield. So you can, if you want to learn about it, that's probably the best way to go about it.
Great, thanks. And then finally, any tax reporting obligations obviously are on the onus is on the user, right? On me. Unlike BlockFi, which is going to issue a 1099 at the end of the year, that's not the case here. Right, in these DeFi protocols, it's pretty much up to me to report my income.
It's definitely up to you. I know it's very complicated for Americans. I'm not sure if anyone has any quick insights there.
Funny you should ask. I'm bringing up actually. So this is my buddy James Perillo, who happens to be an accountant and a CPA.
Yeah, hi guys. Thanks for letting me speak, Rob. So I'm a tax managing director at KPMG in our alternative investment group, and I'm essentially at this point heading the firm's digital asset taxation group. And so, as far as Crypto Nice, are you a U.S. taxpayer?
Yes.
Okay, so yeah, I think you pretty much said it right. So there's essentially two forms that U.S. taxpayers currently are receiving if they're on a centralized exchange. There's either a 1099-K or there's a 1099 miscellaneous, which depending on which exchange you're talking about or what type of platform you're talking about, you'll either receive one of those two. Coinbase has opted for the 1099. Oh, excuse me, not 1099 miscellaneous, 1099B. 1099K is sort of what you'll receive from like a Coinbase or a Gemini. 1099B is something that you typically receive from like another like more formal brokerage accounts, like if you had a Fidelity account or an E-Trade account, which essentially provides you with like your purchases and your sales. And that's what BlockFi has opted to do. Right now, regulations are a little slim on and scant on what's actually required from these companies to provide to their customers, which is rife for tax misstatement, let's call it. So yeah, it really does, and it does fall on the user. And so right now, those are really the two largest and most significant reporting forms that you'll get from the tech from like an IRS form. Now there is something else that we do envision coming to play here pretty soon and being presented and required from U.S. taxpayers, particularly if they are on offshore exchanges or exchanges that are not being hosted in the United States. There's something called, essentially it used to be called an FBAR. It's now called a FinCEN 114. And what that is a foreign bank account report. And at some point in time, what we're envisioning is that individuals and U.S. taxpayers are going to have to report accounts, and they're going to have to somehow provide information about the accounts that they hold. Some information, mostly like, do you own an account, and what is the maximum value during the year?
You're talking
So
about
let's,
bank accounts. I
so-
understand about bank accounts. Are you referring to exchange accounts, like an account on a foreign exchange? Those will have to be reported.
Correct.
Okay, cool.
That's correct.
And then what about DeFi taxation? That's pretty much on your own, right? There is nobody to issue your form.
So real quick, so let's definitely move along to focusing on on the AMA at hand. But we can wrap this up real quick. So what's the answer to that, Jim? What was the question, Kryptonite? Just about if DeFi tokens are different?
Yeah, how's DeFi taxation handled? I mean, that's self-reporting, is that right?
If you move money around on a DeFi exchange versus a centralized exchange, technically you're supposed to be reporting all that anyway. So that's
there's a couple. I'm sorry, I didn't mean to take over at all. So I apologize. Like there's a couple of different approaches, and maybe one day I'll hop on one of these with Rob, and we can talk a little bit more about tax.
Yeah, we were talking about that. We will definitely set that up. In fact, doing that in the month of March makes a ton of sense for all the DeFi degens out there like myself. All right,
it's all self-reporting, and it's a lot of work, and you should work with a tax professional on it.
Thanks, guys.
You got it. Let's see. Matt's part of the UMA team. So Eric or Jeremy, did you have a question? Jim, you can come up and ask a question too, by the way.
I just had an idea that I've been thinking about recently, and I'd love to hear people's thoughts. Connecting every DEX, in theory, should be possible with atomic swaps, right? Because they're all built on top of layer ones. In actuality, not exactly sure how to do it, but it could get really interesting if all the DEXs were, connected, and you could transfer the same pairs between.
Isn't Polkadot doing that? I could be wrong.
Check out 1inch Exchange. So they aggregate all the DEXs, and they route all the liquidity to the different DEXs.
So it's like a smart order router.
Yep. Yeah. 1inch Exchange.
I think they literally call it a smart order router. I think that's the name of their contract.
Yep. Yeah. That's
Boom.
Right. Eric, did you have a question about UMA?
No, I was just referring to, I think Polkadot is building that, but obviously they're not fully released yet.
Cool.
Yeah.
Thanks, Eric.
Hey, what's up, Will?
How are we doing, everyone?
Great.
I'm just kind of in here. I very a little bit more new to the world of DeFi. I know I kind of popped in here. Everyone's talking about how it's going to be taxed. I was wondering what people's thoughts are with, especially with the new pick for the guy who's probably going to be running the SEC. I think he's a blockchain professor from MIT. I don't know. What are people's thoughts on the implications of that? Think it's going to be good for this industry, or going to make it kind of contract a little bit, having that type of regulator?
So for sure, so this particular conversation, we're going to definitely keep pushing towards UMA. So this is a UMA AMA. I don't know. What do you guys think? There are a bunch of Americans in here, though. We could try to keep it to UMA anyway.
Yeah, let's be respectful of the UMA team's time and stick to UMA.
Guys, open conversation. Happy to talk about anything, but I don't have any strong view on this.
I actually had a question on UMA if you'll have some time. Uh, yeah, so I just got into some liquidity pooling with Loopring. I just jumped into it, to be honest. And I just wanted to know how I would go about it with UMA and where and what would be the best for dummies, basically.
Clayton, you want to do some yield farming for dummies?
Yeah, yes, with UMA.
Sorry, can you repeat your question?
Minimal gas fees. Yield farming with UMA with minimal gas fees, like the smartest way for a dummy, if you could explain it.
Yeah, I think I will say minimal, which is to say like relative to other actions, not low. Would probably be mining the yield dollar tokens by depositing USDC. So you can go to the balancer pool and deposit USDC, which will auto purchase the yield dollar token and allow you to be liquidity mining with both assets. And yeah, you're gonna have the gas fee would be to set up the proxy contract on balancer if you haven't done that before for that particular wallet, and then the deposit, which, you know, altogether will be a few $100s. So you would want to evaluate, basically it just depends on how much money you're putting in at once to figure out if it's worth your effort. You'd be looking at around, I think around 45% APY. But as we mentioned earlier with the expiring thing and the need to roll over, the yield dollar product will be rolling over at the end of next month. So you might be looking at about 4 weeks of yield farming. So there's a little bit of math that goes into it to evaluate this. So yeah, that's the.
Sorry if this question is dumb, but when you say rollover, do you mean rollover to L2? Like
Rollover to the next issuance of the yield dollar token, which we haven't actually like formalized what that looks like for the next one, but
the next date.
Yeah, it'll expire at the end of next month.
I think it might also be useful, Clayton or somebody else, to explain a little bit how dev mining works and like the sharing of dev mining rewards and all of that mechanism to help reward people for using products that are basically built on top of UMA. Like you're not just using UMA itself and then yield farming with UMA, you're using products that are built on UMA. Sorry, I'm mixing up my pronunciation now.
How do you pronounce it? How does everyone pronounce it?
I say UMA until this call now, and now I don't know what to believe. But whatever you call it, Clayton, maybe you could talk a little bit about that because I think it's really cool.
Sure. I mean, I was definitely giving the like, how do I earn returns without thinking about it any more than I need to, and actually like for UMA, there isn't a short answer to that, which I like. I think it's cool. But yeah, the bigger picture, like the reason these rewards exist, for example, is that, and by the way, like you're not staking UMA tokens to earn this APR. You're buying a product that was created using UMA to earn the yield in UMA tokens. And so like actually there's a whole suite of products that you can liquidity mine on. And the liquidity mining is actually like a sub-program of this developer mining, which I talked about earlier, which is the program meant to incentivize developers to build products on top of UMA. And so they receive each week a portion of this roughly $1.5 million of UMA tokens each week that's given out. And then they portion it out to encourage liquidity. And so they're actually the ones who are paying this liquidity mining, and they're doing that to make a usable product, right? So like they might take some of the rewards for profit for themselves, then some of them are used for basically incentivizing user interfaces or any kind of marketing. And then they are also used for liquidity mining. And so that's where the farming action comes in. And you can farm in a few different ways on these products. So you could show up with the collateral asset and mint the synth and farm that way. Or you can show up with the pool, the asset that it's traded against in the pool, and then buy the other asset, the synth, and farm that way. So there's a few different, just kind of depending on your portfolio. There's a few different ways to do it. The only caveat to this is that certain assets require that you mint only. You can't show up and buy the opposing asset, the synth asset. So yeah, each one has a little bit of a different program. But yeah, that's kind of the big overview. I would also say that we have a spreadsheet. I think it's like bit.ly/UMATVL that has the different yield opportunities right now. But I will check that and confirm it in a second.
Awesome. Vitor, thank you for your question. Well, I think now is as good a time as any to wrap things up. Really can't thank all of you guys so much. I mean, I think out of all of our AMAs that we've done so far, talk about a proper community. Like you got the whole team up here. I loved it. Before we wrap up, just like quick little housekeeping. So everyone listening, we have a full calendar over at the DeFi Clubhouse Telegram channel, which is t.me/DeFi Clubhouse. The moment Clubhouse app decides to get a calendar integrated with clubs, we'll use that. So Hart, Clayton, team, thank you so much. Tom, thank you for this.
Yep, thanks guys. And real quick, if you're not already following the DeFi Club, scroll up to the top and click on the little green house, and then you can follow the DeFi Club. And we've got a bunch of other great AMAs and rooms coming up in the future. So thanks for coming out.
Thanks, guys.
Yeah, guys, thanks for having us. Super fun.
Thanks all.
Cheers, everyone. Be well.